Look at the calendar. We are racing toward 2026, and for most people, the reality is terrifying. You wake up, you trade your life for a paycheck, you pay bills. You repeat. It is a cycle designed to keep you running in place until you are too old to enjoy the money you finally saved. But while the majority is distracted by the noise of the daily grind, a massive financial rotation is happening beneath the surface. We are standing on the precipice of the 2026 wealth shift. Interest rates are settling, artificial intelligence is reshaping infrastructure, and demographics are shifting capital like never before. This isn't about working harder, it is about positioning. Today, we are not just talking about stocks. We are breaking down 5 specific high-yield income streams hidden within 3 explosive sectors that will define the next decade. This is the blueprint for absolute passive income. No side hustles, no second jobs. Just capital doing what it was meant to do: multiply. Let's build your exit strategy. Day. The first stream capitalizes on the most valuable resource of the 21st century: data. We are moving into an era where AI consumption is doubling every few months. Where does this intelligence live? It lives in physical buildings. This brings us to data center real estate investment trusts, or REITs. The mechanism. A REIT is a company that owns income-producing real estate. By law, they must distribute at least 90% of their taxable income to shareholders to avoid corporate income tax. Data center REITs own the secure facilities that house the servers for Google, Amazon, and Microsoft. These tech giants sign long-term leases, often 10 to 15 years, with built-in rent escalators. You become the landlord for the internet. The setup: you don't need millions to buy a server farm. You can buy shares of companies like Digital Realty or Equinix through a standard brokerage account. You are buying a slice of the concrete and cooling systems that power the global economy. The scaling. The beauty here is the dividend growth. As demand for AI processing spikes, leading into 2026, these landlords can raise rents, reinvest those dividends to buy more shares, creating a snowball effect of ownership. Case study: look at the historical performance of the major data center players over the last decade. Early investors who treated this as a boring utility play saw returns that crushed the S&P 500, not just from price appreciation, but from a steady rising stream of quarterly cash payments that ignored market volatility. The second stream bets on an inevitability. The global population is getting older. The age by 2030, all baby boomers will be older than 65. This drives the second massive sector: healthcare, specifically healthcare dividend aristocrats. The mechanism: healthcare is inelastic. If the economy crashes, you might skip a vacation, but you do not skip your heart medication. We are looking for companies that manufacture essential devices and drugs, which have increased their dividends for 25 consecutive years or more. These companies have huge moats, patent protection, and cash flows that remain stable during recessions. The setup: filter for companies like Medtronic or AbbVie. These are giants that pay you to wait. The entry barrier is low, the price of a single share, but the stability is fortress-like. The scaling: this is your defensive line. When the market panics, these stocks tend to hold their value while continuing to pay you. You scale this by dollar cost averaging. Every month, regardless of the stock price, you add to your position. Case study: consider Johnson & Johnson. Through the dot-com bubble, the 2008 crash, and the 2020 pandemic, they never stopped paying dividends. In fact, they raised them. An investor holding this through the turbulence of the last 20 years has essentially created a private pension fund funded by the world's need for health. Now, identifying these assets is only step 1. The chaos of the market can make it difficult to organize your portfolio into a cohesive strategy. You need a framework, a way to systematize your wealth building so you aren't guessing. I've utilized a specific structural approach known as the wealth system. It helps clarify exactly how to allocate capital across these different sectors without getting overwhelmed. If you want to stop gambling and start building a structured financial future, check out the resource linked in the description. It's about order, discipline, and results. Stream 3 taps into the massive infrastructure overhaul leading to 2050, the energy transition. But we aren't buying speculative tech startups that might go bankrupt. We are buying yieldcos. The mechanism: a yieldco is similar to a REIT, but for energy. A parent company builds a wind farm or solar park. Once it is operational and generating electricity, they sell it to the yield. The yieldco has long-term contracts to sell that power to utility companies. They take that steady cash flow and pay it out to you. The setup: you look for tickers associated with major infrastructure asset managers. You are essentially buying a bond-like equity that grows as the world shifts away from fossil fuels. The scaling: as governments mandate green energy, these companies acquire more assets. Your income scales with global policy. Case study: look at Brookfield Renewable Partners. They operate one of the world's largest publicly traded platforms for renewable power. While tech stocks fluctuate wildly based on hype, their assets simply generate electricity and cash, year after year, providing a high-yield anchor for your portfolio. Stream 4 is where the smart money has moved while retail investors chase meme stocks, business development companies, or BDCs. This is how you become the bank. The mechanism: after the 2008 financial crisis, big banks stopped lending to small and medium-sized businesses due to regulations. BDCs stepped in to fill the void. They lend money to established businesses at high interest rates, like REITs. BDCs must pass 90% of their profits to shareholders. The setup: you can buy shares of top-tier BDCs, like Ares Capital or Main Street Capital, on the public market. You instantly gain exposure to a diversified portfolio of loans. When interest rates are high, BDCs often make even more money because their loans usually have floating rates. The scaling reinvestment is key here, because the yields are often massive, sometimes 8% to 10%. Reinvesting dividends doubles your position much faster than traditional stocks. Case study: Main Street Capital has a legendary reputation for paying monthly dividends and special dividends. They focus on the lower middle market. An investor who parked capital here 10 years ago has received a substantial portion of their initial investment back purely in cash distributions, drastically reducing their risk. Finally, Stream 5. This is for the investor who wants to profit even when the market is flat or slightly down. We are talking about covered call ETFs. The mechanism: usually, selling options is complex and risky, but new ETFs automate this. They own a basket of stocks like the Nasdaq 100 and automatically sell call options against them. They collect the premium, the fee traders pay for the option and distribute it to you as a monthly paycheck. The setup: you buy a fund like the JP Morgan Equity Premium Income ETF. You get exposure to blue chip stocks, but with a massive yield boost generated by the options strategy. The scaling: this is an income accelerator. It won't grow as fast as a pure tech stock in a bull market, but in a choppy market, which we expect leading into 2026, it acts as a cash generator that funds your lifestyle or buys other assets. Case study: during the bear market of 2022, while the S&P 500 was down significantly, high-quality covered call ETFs continued to pay out yields often exceeding 10%, keeping investors liquid when they needed it most. You have the blueprint. You know the sectors, but execution is where most fail. You need a brokerage that offers low costs, global access, and professional-grade tools to manage these positions effectively. For executing these trades, I use Interactive Brokers. Whether you are buying REITs, BDCs, or international yieldcos, IBKR provides the platform designed for serious investors who care about execution, price, and margin rates. Do not let high fees eat your passive income. Use the link in the description to open your account and start building. The year 2026 is coming. The wealth shift is not a theory, it is a structural reality. You can choose to remain on the treadmill, hoping your salary keeps up with inflation, or you can choose to become an owner. An owner of the data centers powering AI, an owner of the healthcare systems protecting the elderly, an owner of the energy grid and the private debt market. This is about absolute passive income. It's about waking up to options, not obligations. The path is laid out. The tools are in the description. The rest is up to you. I'll see you in the next video.